And everybody's mics need to be green, please. Here's two. Okay. All right, you're five.
All right. Calling meeting to order, Town New Canaan Retirement Plan Advisory Committee on November 11th, 2025. So, roll call.
Roll call here. James Yao,
Here.
Bob Hamill,
Here.
Chris LaGrease,
Here.
waiting for last, Steve Doka, not here.
Okay, we have a quorum, so we can proceed with the meeting. We have the minutes from the last meeting of May 13th, 2025. Are there any comments? Do I have a motion to approve the minutes?
I'll move.
Okay, second, all in favor?
Aye.
Aye. Okay, minutes are approved. All right, so we are here really to listen to our guests. So Zachary O'Grady and Justin Owen will walk us through what they think is relevant at this time. Okay?
All right. Well, thank you. I guess I'll get us started here, but obviously you all have met with Justin several times. My name is Zach O'Grady. I joined Russell Investments earlier this year. I spent the last decade of my career working for PFM Asset Management in a similar role. I was based out of New Jersey at the time. I work out of Russell's New York office, but the bulk of my career has been working with specifically plans in the government space. So I've spent most of my career working with local governments. In a prior life, before joining Russell, I was a member of the Connecticut Pension Forum, Public Pension Forum. I've spoken before at the New England States GFOA. Been to the CCM conference a couple times. So it's nice to be back in Connecticut. Thank you all for having me. I look forward to working with you all on a go-forward basis. I know Rich Nolan, who was your prior contact at Russell, will be missed, but I hope to provide the similar level of investment expertise. Obviously, still have Justin to work hand in hand with. So I will get started. I know, Diane and I were chatting several months ago. Wanted to confirm that we did in fact make make those asset allocation changes that were voted on last meeting. Which did take place. Certainly it's been, given what we've seen in the market, it's been pretty beneficial, broadly speaking, to build out a more broadly diversified portfolio versus some of the investments that you were in prior. And I think moving forward, it's a prudent strategy as well. So I'll start on page 6.
Can I ask a simple question?
Yeah.
And it's actually on page 6.
Oh, yeah.
I took a look at this and I see, where we are 9/30/25, but then going all the way back to page 42, when I got to the end of it, what I didn't understand is, you go to that page, it shows current, which is not what we agreed to. We agreed
No, and
to
that's,
D. So I'm trying to figure out what are we,
yeah, and I can explain that. So this is just, we kind of lifted the slides that we had from when we did the strategic review earlier this year and threw them in the appendix.
Okay.
And that label,
so
it
current at
definitely
that
missed it.
time, okay,
At
because
that
that,
time when we
all right.
presented it in May.
all right.
Yeah,
That
yeah,
is
sorry about that.
That's a little confusing. All right, because I was wondering whether it looked like we've made the move, except it's not that granular. And then went to page 42. and
Yeah,
it
we
looked like
included it
hadn't
there
made
for
the move.
reference without, we should have put a little, a label on there
Flashback,
that this
all right.
is from the prior meeting.
I'm glad
Yeah.
we made the move because it was good. All right, thank you.
Yes.
Yeah, and on page, I think it's 42D, those are strategic target asset allocations to each of those respective asset classes and sub asset classes. I think they're rolled up a little bit differently on 6.
So that's why I'm having trouble figuring out. We adopted D at the time. It's in our minutes. And I was
Yeah,
trying
so-
to figure out how that comports with what's on page 6.
So a couple different things. I
Okay.
think we rolled up a little bit differently. So for non-US equities,
Yep.
that would include your developed non-US equities
Okay.
and your EM.
Okay.
And it's also what we're showing here on page 6 are actual asset
Right.
asset allocation based on market values.
Got it.
And usually I think we'd show any deviations from quarter to quarter, 6:30 to 9:30. But in this instance, since you did make such a, I'd say rather big strategic change,
Yep.
wanted to show where you came from March into the end of September,
Okay, thank you.
of course.
We
But as
do
far,
have a kind of a tolerance level around the strategic asset allocation, so we'll rebalance when it falls out of bounds. Typically, those are about 2% is what we keep it tight to.
thanks, Justin. And so yeah, that's actual asset allocation through the end of September. Performance for the third quarter was relatively strong on an absolute basis. If you were to get that annualized 4 quarters in a row, you'd be pretty happy for a full calendar year. But from a trailing standpoint, absolute returns relative to benchmarks, pretty strong. I mean, most of the, as you're well aware, your non-US equities in developed markets and large cap US is largely passive. So you'd expect that to track the index where you're generating outperformance versus the benchmark over a 1 year and long-term time periods, or that dedicated world equity allocation, your allocation to active implementation to emerging markets, small cap equities, and then of course, fixed income. And I'd say largely speaking, that's played out well over the past year and since inception. So doing well on an absolute basis and versus the benchmark again. And I'd say what's driving relative returns versus the benchmark have been your allocations to emerging markets and world equities. Those fund allocations have exhibited outperformance over the past year versus their respective benchmarks. Small cap's a little different. It's been a challenging market environment for small cap equities. So if you were to look at contribution to performance, that would certainly have detracted from relative performance. But nonetheless, we're still ahead of benchmarks. I just wanted to point it out. It's been a relatively challenging year for small cap equities.
It's almost like there's been a lot of tax loss selling, and so it's almost reinforcing the way down. So maybe, hopefully, come out of the new year with the January effect.
Yeah, and it's also been a really speculative, like a lot of the managers. So it's a multi-manager approach within small cap. We have several managers within our small cap portfolio or small cap allocation, but we've really been caught in, if you look at the past, especially the last quarter, a highly speculative growth rally. And what I mean by that is if you look at the best performers in the small cap equities over the last quarter, there's 7 companies, top performers in small caps, that have returned anywhere between 300 and 3,000%. 6 of those 7 companies are non-earners. And NA, when you look at EBITDA in small cap. So naturally, some of the managers that we have in the portfolio aren't overweight those names and have had big misses versus if you look at the Russell 2000 index over the quarter. So just I think just wanted to point that out from relative performance contribution. This is just a market value reconciliation over the quarter, and it's just for the retirement plan. So it's not the OPEB or the scholarship fund, but you started the quarter at $183 million. Net flows, $1.6 million, resulting in your net investment gain over the quarter of just over $9.6 million. Ending balance there of $191.59 million through the end of the third quarter. I touched on earlier, if we look at 7, this is just an executive summary of sort of our key watch points and broad market returns for as we look at year to date. International equities have certainly led the way. So that broadening out of your, what I would say, further diversifying your portfolio is not that you were making this decision to time the market. It's a long-term asset allocation decision, but timing wise, I think it's been somewhat beneficial to performance. Not only have international equities done well over the quarter, so international companies are doing well in their own rights, but the theme throughout the past 9 months has been, if you look at over the past 7-8 years, the dollar, relatively speaking, to other currencies has been on a tear, and we've seen a bit of mean reversion in currency movements year to date, which is when you convert those returns back into the local currency, a tailwind for international equity returns year to date. US equities also doing fine on their own 14.6% return. It's kind of remarkable when you think about year to date returns, 14.6%, withstanding a pretty swift and precipitous sell-off that we saw and experienced in March and April of earlier this year. Global real estate and bonds, two areas of the market that are, I think it's welcome to see that are doing well this year to date. I mean, you lived through it in 2022 when the Fed was aggressively raising the overnight lending rate. Aggregate bonds, 6.1% return for the year, and global real estate, 11.3% return. I will spend a little bit more time talking about sort of highlights. If we flip to slide 9, third quarter, I touched on a lot of this already, but soaring equity markets, if you look whether domestically or international, especially in the US, equity markets hovering around their all-time highs. Valuations in the US are also hovering around their all-time highs. Small cap shines in the quarter. There's been, after several challenging quarters for small cap, this is a pretty big rebound for small cap over the quarter. We'll talk about that a little bit further. If we were to look at the recessionary probabilities that we were sort of pricing into the market when the tariff announcements were made in March and April, or Liberation Day earlier this year, they were much higher than what they are currently. And I think we're largely seeing a sort of softish landing scenario for the economy. The economy's been quite resilient. I mean, corporate earnings have been relatively strong. I think through the end of second quarter, somewhere around 8% growth year over year for the S&P 500. I think what's important for us when we're looking at corporate earnings in the third quarter is that double digit year over year growth in S&P earnings. So really resilient earnings. When you strip out Mag 7, the Magnificent Seven effects from corporate earnings this quarter, still double-digit growth for the S&P 500. So it's nice to see some of a bit more market breadth, still resilient. I know there's been a lot of noise lately, especially with you see these large headlines come across from Amazon, UPS about large significant layoffs, but largely speaking, the labor market is still intact, albeit I'd say cooling. And that's an important area that we're looking into is whether or not we see any more further cracks within the labor market. I think is going to be a key watch point for us because the labor market obviously spills into other areas. If you look at things like consumer sentiment right now, Michigan Consumer Sentiment Index, it's hovering around it's low in the past 5-7 years. But at the same time, so that's consumer sentiment, but consumer spending is still relatively resilient. So I think any little bit of deviation there, but I think focusing on any cracks in the labor market is going to be an important watch point for us moving forward.
And you may have noticed the recession probability at about 25%. Average on a normal year is between 10 to 20%. We're only a slightly above what would be just kind of a neutral position. That was as high as 40%. Just as of the last year or so, some had a 50% or higher recession probability. So, but consensus in the industry is bringing that down quite a bit.
I'll just flip to slide 10 to talk about, this just expands upon other areas in the market and how they perform not only in the quarter, but year to date. So I know there was a lot of discussion at your prior meeting when you went through the asset allocation exercise about different areas of the market, whether it be non-US, specifically to emerging markets. Year to date, if you look across the page here, it's a risk-free market. Not that it's a risk-free market, but emerging markets have been the highest performer year to date, almost 28% returns from EM equities. And that's just for the benchmark. Like I said earlier, relative performance has been positive when we look at the managers that we have in the portfolio. I think other areas you have dedicated allocations now to REITs within the portfolio as well as infrastructure. So if you look at the past quarter and over the past year, that's done relatively well. I think importantly, if we look at this plan that's well funded, the retirement plan, and you went through that risk return exercise, you added incremental risk to the portfolio, but you also added incremental return. So your unit of return per unit of risk went up a bit. So I think it's important building out this sort of broadly diversified portfolio for such a well-funded plan should prove to just be good, I think, in terms of broad market events, sell-offs, in terms of building out the overall correlations of how these asset classes behave against one another.
And you'll notice in the page on the top, the balanced index portfolio, that's not exactly your portfolio, but it's kind of close. It's a 65-35 portfolio mix between public equities, real assets, and so forth. So if you want to get just a rough sense ongoing when you see this, that's about where it lands. And you'll notice quarter to quarter, period to period, that's going to be a lot more stable than a lot of these others that are going to have their peaks and valleys.
On page, I won't spend a lot of time on page 12. If we flip over to page 12, but this was just magnifies sort of what I was speaking about earlier in terms of local currency returns across the globe and how the weakening dollar has impacted those when you convert them back into dollars. So it has a tailwind effect for international equity returns, and you can see that across developed and against most of the developed markets on page 12.
Yeah, on the emerging markets, sorry to interrupt, but that was one where you do have explicit target to emerging markets. It's limited. It's 2% right now, which is lower than the global market cap would imply, but we had a good discussion on it earlier this year and landed on that point. So I'm glad we do have some exposure to it, but also acknowledging concerns in that asset class. So we have some of that exposure that did the best this year, but not as high as some others would. But I think, yeah, we're comfortable with where that's at now.
Thanks, Justin. And on page 13, this gives you, I think it's a good view of most central. I mean, some of this has already taken place given this is through the end of September with the Federal Reserve, but this is central banks and the expectation across the globe. The orange bars here on the page are the overnight lending rate set by various central banks across the globe. And I think broadly speaking, the market is pricing in that most central banks will be easing rates throughout 2026. We've seen that already take place in the US with the Fed cutting in September and October, or the end of October, at their October-November meeting. And I checked this morning, the Fed has a meeting in December. It's not as conclusive as to whether or not the Fed or as to whether or not the market's pricing the Fed cutting in December. Still some good data points to come in now in between that December meeting. But I think the market was pricing in about a 63% chance of a December rate cut. So that would be an additional rate cut that we've seen 3 consecutive rate cuts in a relatively short time frame. I think 14, I won't go over 14 in too much detail. These are just, if you wanted to look at sort of asset classes and our preferences in various asset classes across the globe. You can see sort of some of the green areas that are shaded where we're more positive and some of the red areas where we're not. I mean, I'd say broadly speaking, the big takeaway for, at least in the fixed income markets, spreads continue to be very, very tight in the investment grade and even high yield fixed income universe. So that when we're looking at the underlying manager allocations within fixed income, they're not taking undue credit risk in the portfolio, given that spreads are at all-time tights. In the investment grade universe. Anything?
Yeah,
to
this
add
is
there, Justin?
the tightness of the spreads is concerning in terms of the return potential. This is why you'll see headlines about trends towards private credit, private debt. We're seeing that a lot more the last 5 years. And it's something we can discuss with you at some point as well, if it's something you're interested in, but that's why they're seeking return, and it's becoming a much bigger, more robust market for private credit right now, both in the unrated and the investment grade rated space.
Yeah, I was gonna say, no.
I
I did high yield and that was about
Still
as,
no.
yeah, I think it's like, that's about as risky as I would.
More risky.
Yeah, no thanks.
Yeah.
After the shakeout,
Everybody chasing,
nobody wants it.
everybody's chasing.
That's gonna be my
All right, well, I think we can get right into the portfolio. I mean, the next section here is just a Russell Investments update. So if you ever wanted to flip back to the book and get an update on Russell Investments, I won't go through every page here, but it's there for you. We frequently have educational opportunities, whether they're webinars. Justin's been pretty busy writing white papers. He just presented at a pension and investments conference recently. So anytime you want access to any of that information, you want to get added to a list for webinars or educational opportunities, let us know. But I'm not going to do a deep dive on Russell Investments at the moment. We can flip to page 22, which is just a overview of cash flows, not only for the past 3 months, again, for the retirement plan, but since inception. So again, I walked through the past 3 months on the first cover page there, but you had net flows to the plan of 1.6 million. So you had 982,000 come into the plan, $2.6 million leave the plan, resulting on a net appreciation number of $9.6 million. Since inception, this is going back now, just for frame of reference, to July 2nd of 2024. So we have a little bit over a year of data here. Total net outflows over that time period, $11 million. Total net flows to the portfolio, 164, given we started with 0, and a total appreciation number there. Total gain on investment, $27.1 million. Same ending market value of $191 million. Justin sort of touched on this on.
The date of inception.
I said the footnote, July 2nd.
Oh, there it is.
Yeah, July
Yeah,
2nd.
yep, 2024.
Justin, I mean, we have a pretty, I'd say tighter, memorialized rebalancing policy. If you look at 23, such that we're not making any significant bets or deviations in terms of where you're at versus your long-term strategic target. So if you look, broadly speaking, total equity, about 90 basis points overweight in aggregate versus their long-term strategic targets. Most of that coming within U.S. equities. We rebalance the portfolio on a monthly basis. So anytime U.S. equities, as an example, would get plus or minus 2% of its long-term strategic target, we would rebalance the portfolio. We didn't have to rebalance at all over the quarter, else it would be noted here on this page. But not making really any significant shifts or bets across the portfolio at this time. I think reflecting, we're in a much better, albeit, Justin said, people searching for yield, but we're in a much better spot in the fixed income market, generally speaking, now than where we are. So sort of balancing the risk return profile of the fixed income markets, where you can get 4.5% yields in the fixed in the Bloomberg and the aggregate bond space these days, with balancing the risk of U.S. equity markets at all-time highs, international equity markets doing very well year to date, and then you have your other diversifying assets in there, which are the REITs allocations and the listed infrastructure allocations. So I would just say, if I were to sum that page up, sticking both in the retirement plan and the OPEB sticking relatively close to the targets at the time, at the moment. You get a bit more information on returns here for the retirement plan, showing a couple more periods on 24. So just again, reinforcing strong relative returns, very close on a quarter-to-date basis. You can see the difference between gross and net returns, 5.28% on a gross basis, 5.23 net for the quarter versus our benchmark at 5.33.
And you'll recall that we had a good discussion around where we should be active and where we should be passive, because of course you came from pretty much all passive in the past. We're not passive in US large cap. We don't really want to play in that market as well. It's been tough for active management. US developed, non-US developed, we're also passive in as well. You know, the information sharing is quite efficient and there's just not as much opportunity there. The other areas we are active in, small cap, EM, that small allocation, and then a broad world equity allocation. But other than that, you shouldn't expect that this is going to have like wide swings on performance period to period because you're passive in a lot of your assets already.
I just had a quick question on 22. Should I read this? It says, so on 22, the net market gain or loss for the quarter is 9.644. Is that correct?
Yep.
So if I was looking at or wanted a thumbnail, an annualized return, would I multiply that by 4 and divide it by 183.624? Is that what I would do? Or is that what is that? Right, if it's that's for the quarter, right, then I assume I multiply it by 4 and divide it by the.
So if you wanted an annualized return,
Annualized
that would roughly be it, adjusting for, you know, the inflows and outflows. But yes, that's roughly.
That's
what it would
roughly
be.
it.
Yeah.
Okay, so that would be like, no, but your appreciation, depreciation, it's not net of inflows, outflows, just of the portfolio, or then that's.
Yeah, it's just portfolio. The
That's
inflows
just
and
a
outflows are
portfolio,
on the
right?
top.
The inflows and outflows are separate.
Those are separate.
Right,
Yeah,
those are
those are
people
explicit
contributing and
contributions that are coming in.
Contributions and pensions
Benefit
paid.
payments going out.
Yeah.
And then
So
it
that's-
just kind of solves for making the math all work for the beginning and ending value is the. It's
So the
investment
appreciation,
risk.
depreciation, is unrealized gains and losses on the
It
portfolio.
is, it
correct?
is all gains and losses because it's just market value. So it's for that time period.
Okay, so multiplying it by 4 and dividing it by the starting balance is a rough thumbnail of what the annualized return.
It would
for
be
the
a
quarter
rough
would be,
one,
right?
yes, yeah.
Yeah.
And
well,
that's
they-
21%.
21%
And
or
that's
so, yeah.
kind of, we did 5.3 in the quarters.
Yeah.
Yeah.
Okay.
That works.
Yep.
Right.
But since inception, you basically have 5 quarters.
That
Yeah,
would be.
So that'd be like
5%.
19%, I think, because I multiply the 27.147 by 1.25.
Right.
And then divide it by the balance.
That would be a rough, yeah.
So
But again,
19
that's not
to-
annualized, that's
No.
total.
Yeah.
If we wanted to see, from time to time, more historic numbers, so when you talk inception, you're talking when you took over the portfolio. What I like to think about inception is maybe looking back maybe not since we started the fund, but 10 years or so, it's kind of see.
That's our problem.
That's our problem. But where can we get that data? Do we still have the old data from the
I
prior managers?
certainly have all of the asset data, the inflows, the outflows, and we could recreate it.
So
like
if we
this.
wanted to see that data, you guys could provide it for us.
Correct.
Okay. I'm not asking for it, but I'm saying it might be something useful because fundamentally the issue is that we, on any given year, the inflows don't match the outflows. So if we have a negative market return, we have both a net outflow.
Yeah.
And then whatever, this is great that we have these gains, but it could go the other way. And then it just builds on itself. So,
Yeah.
I'd like to kind of see, maybe for the next meeting, we go back 10 years and give us these numbers, or the inflows, the outflows,
Mhm.
and the gain or loss on portfolio.
Okay.
In our old strategy on the investment side, and I wasn't on this committee, but just on the pension committee, it was literally Vanguard,
Yeah, but it doesn't make
passive,
it,
and, 60.
I know, and the
but-
management of the,
So the
what
market-
we do changed a little bit, but it just gives, just so we have a sense of kind of our relative risk. And it's more for us internally than for you guys. You guys are managing the market risk.
I mean, I can look monthly if you want, but quarterly would be nicer. Less work.
It could be
I
annual.
was gonna say,
Annual,
like
that's
10
what it
years
is.
back, I'm not sure.
Okay,
let's do annual. That's what it sounds like.
Okay,
Let's
so
do
I'll
annual.
start
It
with
could
the
be
annual.
annual,
We can't really do
I mean,
much
we know
about
what
it.
it's,
it
what
could
the
be
pension
annual
pays out.
as of the
Pension.
fiscal year end. You know,
Yeah, it's
I mean,
easier
yeah,
to.
We have an
this-
annual report.
It
for each of
doesn't
those.
matter. I mean,
Absolutely.
when you start looking at 10-year numbers, it's an impression that you're
Sure.
getting, and not, we're
Yeah.
not looking for, well, I'm not
Mhm.
looking for.
And that's why the
granularity.
actuarial required contribution is, I mean, they smooth all that
They
out so
do.
that you
5-year
don't crush
smoothing.
yourself. But if you're in a prolonged bear market, you're right. I mean,
Yeah.
absolutely, you gotta
It-
contribute more and it's a tougher world, but they don't hit you every quarter. We don't get whipsawed because
No, we don't.
that's why they do it, whether it's.
Yeah, typically the actuary will smooth over 5-year time
Mhm.
period.
Yeah.
And they're often they include in the valuation report year by year historical returns for on a market value basis and also on an actuarial basis, which is a 5-year smooth period. So that it may already be there for you. I'd have to take a look at it, but that's a common thing to include in actuarial.
Okay, so the inflows include both payroll contributions and any monies that we move into it as part of the budget process.
Yeah.
One time annual,
Okay,
usually like first quarter.
yeah, so there's a lot of numbers in there.
Yeah.
Mhm.
And every 3 years, what we offer up to our client is to do a full asset liability study where we do a deep dive and forecast out 10 years with our stochastic or randomized like economic scenarios. So this would be the year after next, but if you needed to see forecast before then, we'd be happy to do it as well. That's something that we routinely do for our clients.
Okay,
I think adding that data point is important, especially because I've found it helpful at the committee level and just having these discussions. You have a down year like we had in 2022 as an example, and you have those long-term numbers, 10, 15 years. The Bloomberg Ag sold off negative 13%, equity markets were down 22%. But you could have a trailing 15-year annualized return that's something like, whatever it is, 6.5, I'm making it up, 6.5, 7% return is a good sort of guiding North Star to say, are we as a committee in conjunction with our investment professionals making making sound decisions, making good asset allocation decisions over the long term, withstanding.
So when you
market
do that
cycles.
study, the actuaries kind of do a similar thing to get their ARC. It would be interesting I guess it's more granular, so you're drilling down into the age of the people that are retiring to.
I'm
come
not
up with
doing
that, or-
no, it's forecasting. So so what the actuary will do is they'll calculate a liability per participant as of one point in time.
Mhm.
I take that and say, what is that going to look like in a year, in 2 years, in 3 years? We go out as much as 20 years. And then what you see is the forecast of the ARC every single year in the future. And how is it
And on
impacting-
different scenarios.
Yes,
Okay, got
yeah,
it.
we'll run
That's
1,000 different scenarios. Yeah, so it's it's a range, right? Instead of a specific number. Yeah.
interesting. Okay, thank you.
23, we went through 23, but 25, this is a breakout of all the underlying managers within the retirement plan, and it's very similar in orientation to what you'll see in the OPEB plan. But as an example, as Justin mentioned, your anchor allocations, if you look at the far left, large cap US equities, we are completely passive, implemented through a BlackRock iShares vehicle. Same thing when you look at non-US equities, the third column in, completely passive in non-US equities. I won't go through each in detail here, but this is just a breakout of what makes up the underlying funds in the portfolios. From time to time, quarter over quarter, we will note to you when there are manager changes within the funds. Over the quarter, there were no manager changes to note at this time. Onto the OPEB plan on 27. Same market value information. This is a roll forward of market values for the quarter and since inception, $24.4 million. Net market gain, $1.3 million. You had sort of minimal inflows and outflows, obviously out of the OPEB fund, $13,000 of inflows, $8,700 of outflows. Ending market value there of $25.7 million. And 28 and 29 are just a represent now that each from a structural standpoint, the retirement plan and the OPEB have same, broadly speaking, asset allocation. So similar themes where we're overweight and underweight within the portfolio, very tight to the strategic targets versus our long-term strategic targets. Performance numbers there on the page for the third quarter, 5.45%, 5.39% on a net basis. Largely similar returns as what you see in the retirement plan. The only, I think the material difference that you'll see from time to time from the retirement plan versus the OPEB, moving forward, they'll probably move a lot closer together. But I think largely speaking, the difference in returns on a go-forward basis will just be the timing of cash flows that come out of the retirement plan on a more frequent basis than the OPEB plan.
And the OPEB is not as well funded on a percentage basis as the retirement plan. So the required contribution, at least the last time I looked, was actually higher within that one. So you get more contributions coming into that, which should lead to it kind of growing at a faster pace over time.
And the last couple of pages here on this.
One other question.
Yeah, question.
On page 30, you have kind of the drill down allocations in emerging markets, small cap, large cap, just for those categories. And then you don't have that on page 25 or for the left side of the page. I'm just curious, and I kind of like the drill down just because any reason why there's more transparency on page 30 for those categories. I assume that the 0.4% Alamos, 0.8% Ranger, that's how much of our money is in those funds.
Oh, probably the Global Equity Plus Fund that's on the right hand side.
Yep. I'm trying to figure out, I mean, there's good transparency there, but I just don't see it on the other pieces. Because my question was going to be, in every one of these categories, there's Russell Investments Positioning Strategies, which I'm sure is great, but I just wanted to kind of be sure that that wasn't taking an outsized piece of the allocation, unless you guys really have earned it.
Right.
You know what I'm saying? I mean, it'd be great to manage all this and earn this.
Well, and a couple of things that I'll mention, and then Zach will have some other things to add. The positioning strategies, we're not stock and bond pickers. That's not what we do. But our portfolio managers do have discretion to say we favor this sector more right now, or this approach, right? So we'll do some of that discretion, but we're not actually putting a slice of our proprietary, small cap bond picking, strategy. The other piece is that the retirement plan and the OPEB plan are in a different, what we call a fund structure.
Mhm.
Retirement assets are allowed to be in one, whereas the retirement medical are slightly different. So there's going to be some subtle differences between the manager lineups between the two. It's a good question though on the, why not the breakup of those two? That's one that we may have to look into to see if we can get more transparency on the World Equity Fund.
Yeah, I agree.
It may just be good to see that. Thank you.
Yeah, we can follow up on that piece.
If we go to page 32, this is just the same market value reconciliation pages for the scholarship fund. No net inflows into the fund for the past 3 months. $21,000 of net outflows. You had market gain, $85,000, net market gain, $1.8 million ending market value for the quarter. Similar theme, if you flip to page 33 versus where we're at versus our strategic targets. So I think a bit different in a sense that we don't have dedicated allocations to things like REITs or infrastructure in this portfolio, which would account for some of the return differences between the two portfolios, but also in this fund, if you look at 34, obviously strong absolute performance. If you look at the time periods, I mean, 10.5% return over the past 1 year. A bit of a difference versus the benchmark, relative performance versus the benchmark. The scholarship fund from an implementation perspective is largely active in areas like US equities and non-US equities, which would account for, it's been a.
Why is that? I don't have the history on that. Or we weren't allowed to put them all in the same sleeve.
Well, the purpose of this fund is to generate income, whether it's dividend or interest income, because that's what the scholarship each year is determined by.
Okay.
Not necessarily appreciation of the assets, but
So
whatever it's
Quality.
throwing off is what is determined to be the scholarship that gets
Got it.
awarded to the one student. So there's a
they're not
different,
trying for total return. per
No.
se. Got it.
no, I mean,
It's but you have
But
you have
nice,
to balance
yeah,
it, right?
yeah,
Otherwise, if
exactly.
you just went for junk bonds, you'd pay out a lot, but you'd have no scholarship over time.
Yeah.
But, okay,
So
thank you.
these are actively managed. Is that right?
Yeah, so if you look at the underlying manager lineup on 35, all of the underlying investments, large cap equities, developed markets, emerging markets are actively managed.
Yeah,
just-
this particular fund can't be in our other type of like retirement asset types funds, but these are essentially in mutual funds.
I'm wondering what the difference was like in fees, because I'm assuming this is, that return since inception is net of, is gross with fees, right? Is that the difference might just be the fee? Or is
I
that?
mean, it's a pretty different.
It would be
pretty
both.
different out.
It would be both slightly higher fees and relative.
Yeah, so I would think that that's some of the difference.
Yep. Um,
And how was that allocation determined? I haven't been on this committee for long, but was this, seemed like we made the moves all at the same time, but I don't remember the rest of this.
this one's been at this, this split, 66,
Okay.
30, more like 65, 35 for a while.
It was mapped over from what it
Mhm.
was before.
Okay.
Yeah, and that one we haven't, we don't,
Got it.
there's not really a liability associated with it, so it wasn't, like we didn't do a forecasting on that.
And it's very, I mean, it is very
More of an
small, but
income
it's still,
focus.
Yeah, we really
Yeah.
haven't changed this much over the years.
well, it's kind of an interesting benchmark. That's
Yeah,
compare against.
yeah.
All right, thank you.
Yeah, because, so this is your proxy for 65, 35. Well, okay.
It's been
Started
that
with
way for.
750,000, so it's come a long way after
Right.
paying out
Yeah.
pretty big scholarships over the past 15 years or so.
So the scholarships are just a carry. Dividend income, interest income, is that
Correct,
right?
that's it,
So
yes.
every year, whatever it generates, it goes out as a scholarship for
Correct,
that
it
year.
could go, and fortunately, the last 5 years, it's been going up and up and up.
So it was seeded, so the generosity was 750,000 to start in this.
Correct.
And when was that? Just curious.
Let me think, 2007, maybe? So not quite.
It's even more
20
impressive.
years.
Came in at-
Right, right before the fall.
I mean, you
Okay.
can tell by the outflows, the recipient who's getting money this year is getting a $42,000 scholarship.
That's awesome. And did it go to So it goes to one.
one
Oh,
student
that's
for just their freshman year of college.
That's great.
The payout was 42,000.
Well, we
Oh,
paid out
okay.
we paid out for the first semester. So that was what you see, that 21,000
Yeah,
in the first 3 months. That was to fund the student's first semester. We'll pay it out here again in December for second semester freshman year.
no, I see. So yes, okay.
Right, and that's, so that's why you're kind of seeing
In the world we're in
57.
that, well, in the world we're in, that doesn't cover.
I know, but it's
It's
helped.
a heck of- oh, it's a heck of a nice-
Given the
no,
scholarships
no,
that
no,
we give out
trust
at
me,
high
it's-
school. that's
No,
very
no, it's
generous.
great. I'm not, no,
It
it's
is.
great. It's just
It's about half the tuition.
I know, it's just sad, well, depending on where
Well,
you go.
we've
but-
discussed,
but yes,
honestly,
I'm
I've
just
had some
saying.
conversations with the Board of Ed about what if it gets to the point where a student's, I mean, depending upon where they go, maybe if this were to grow to 50,000, maybe they don't use 50,000, but I don't know what the cost of college tuition, maybe we don't have to
Figure-
worry.
Private university is way
Yeah.
beyond that right now. My kid's been out for a while. Get ready.
Oh, I have one in college.
No, I know, but even at
No, I
the
see.
state school, I mean, you
Yeah,
know, and if they get other merit
Well,
aid or
presumably if you can
something.
use
or-
it toward room and books, I don't
Right.
know what the terms are.
Yeah, there's,
Hmm.
it's a good story.
Inside out.
Everything is at least $90,000 to start any private institution.
Thankfully out of that business.
Oh, man.
Hope to stay.
I live in, I live like in between Trenton and Princeton, and there's a private, it's a grade school and high school in
Yeah.
Lawrenceville called the Lawrenceville School.
Yes,
No,
the
well.
leader to Princeton.
You know Hamel House? It's my ancestors.
And yeah, it's definitely pricey.
More than college.
Yeah.
Yeah.
Well, there's only one other thing I wanted to cover on 42, just to follow up on, you know, we've already approved what is portfolio D here. Just a quick recap of that discussion from a few months ago. If there's any follow-up questions or any other asset classes that have come to mind that you'd like us to give an opinion on. But on 42, I kind of peppered in some of these comments already, but relative to portfolio A, which is where it was coming from, we did include a small allocation to emerging market equities. You'll see that 2% right there. Global market cap would imply that would be a little bit higher, maybe 3 or 4%, but you're a little underweight there, but we're comfortable where that's at right now. And also the inclusion of a global equity mandate, which we're big believers in because they can look at the entire public market opportunity set. And then
Can they look at in global, I know it's US and non-US, was it non-US developed only, or can they be?
So within the retirement plan, it is just developed.
Okay.
Yes. Within the OPEB, that fund structure, it's a broader set. It can include emerging markets.
Because, I mean, China's an emerging market. It's arguably bigger economy than the United States. I mean, I got wicked problems with the markets, but I'm just, the way the world is sliced, and I guess South Korea developed or not developed. I mean, it really, you have these lumpy decisions made by powers that be. I'm not even sure who puts them in there, but it really, I mean, manager ought to be able to almost pick their market.
Yeah, and this is what we found is that the managers we've chosen have been pretty skillful at picking the right markets. It's performed really well. But yeah, and that's not a big part of your public equity allocation. It's, 12% on a total 100%, but it does give you a little bit more dynamism on the total public market. Then the other important piece is allocations to listed assets. So this isn't private real estate. This is publicly traded daily liquid REITs, or what we call them in the biz of listed real estate, and then also infrastructure, which have been a good add-on, good diversification relative to the overall market. So those are the main points. There's obviously a lot of, the opportunity set for investing is very large. I like where you're at right now, really good diversification, highly liquid. And, obviously there are other more exotic things that we can talk about if you want to, but it's, we definitely want you to be the drivers on which ones you would be interested in. Just making sure you know we can talk about them, but certainly not going to push you into any other, solutions unless if there's no interest.
Okay. Any other questions? All right, I have one question. This is on the agenda of the Board of Finance meeting. Do we want to ask them to stay in, what's your time today? Do you have time to talk to us
We can
around
stay if you-
seven?
They usually come to.
They-
vote.
Yeah.
They
They
always.
will,
Yeah,
but
you
they'll
always-
shorten it
last
down
time
to
they
like
did.
10 or.
So,
15
yeah, in
minutes.
May I stayed for, I think I presented 5 or 10 minutes. So it wasn't
Yeah, we'll
very
try to put you at the beginning of the
Yeah.
schedule.
Great.
so
They at
that-
the beginning of the
think they're-
agenda.
Yeah,
They're
we'll-
at the beginning.
yeah,
We just
okay.
have something in between.
Excuse me?
We just have the WBC.
Yeah, I mean, we have this other meeting.
Yeah, it's a half hour.
That's gonna be.
It's
quick.
good.
Half hour.
That's a
So
quick
at 7:00,
Yeah.
if you went to the big room at the end of the hall here,
Mhm.
and then we'll make sure, we'll amend the agenda to have you be the first speakers and then you
Great.
guys can,
And how much time do you want us to take?
10 minutes to kind of go over the big picture.
Sure.
Q&A, if any questions come up, and then, so 15 minutes maybe total.
The overall board was definitely aware of the move we made, but
Right.
be a good reminder and
Yeah, and they'd like
then
to-
just the performance.
Yeah, I think the performance after the move, would just reinforce them all.
Yep.
And their.
It's the right decision.
If
understanding
it wasn't
of the
good,
right
we'd
decision.
say maybe we'll get home for dinner.
All right, so can I have a motion to adjourn the meeting.
Motion to adjourn.
Second? Okay, so moved. Meeting's adjourned. Thank you so much.
Gosh. You guys need any coffee or tea?